Thank you for tuning in. Today, I will be going over 3 dividend stocks that I am buying right now. Before diving into the content, if you like this type of videos, straight to the point, and where I show my portfolio at the end of every single episode in full transparency, then consider subscribing. It's free and it helps the channel out. Okay, the first dividend stock is 3M. The 3M company is an American multinational conglomerate corporation operating in the fields of industry, worker safety, U.S. healthcare, and consumer goods. It has a portfolio of over 60,000 products, so this is a well-diversified world-class business. The stock price is sitting at $147.38, and year-to-date is currently 17.08% down. The stock has been trending down for a while. This is due to inflation, margins getting crushed on weak earnings, and the ongoing news of the lawsuit for earplugs used in the military. This lawsuit will be putting some economic strains on the earnings of the company short term. When we look at the revenue of the company, it has been a bit flat over the last years. Estimates are indicating that they could increase in the future, but time will tell. The earnings per share has been up and down as well, with the same indication that in the future they could increase. Taking a deeper look at how much it is growing, we have to keep in mind that 3M is a mature company, so it is expected to not have huge margins. The revenue year over year is almost 10%, with a 3-year growth of 2.57%. Taking a look at the dividends, it has a dividend yield of 4% with an annual payout of $5.96. Payout ratio is 58.50%. This is very healthy for a mature company that has been increasing its dividends for the last 63 years. It has a 5-year growth rate of 5.65%, which is above the average inflation, and it gives extra room for growth. I will continue to buy 3M at this price. I know the lawsuit could dent the cash flow of the company, but I believe that they have the revenue and the resilience to continue providing value to its shareholders. Next one will be Starbucks, an American multinational chain of coffee houses and roastery reserves. Starbucks is currently the biggest coffee house chain in the world. It's currently trading at $80.92 a share, and year to date is currently down 30%. The reason for this decline is a combination of international market problems related to the government, unions, and the cancellation of the share buybacks. Starbucks is a fast-growing company that brings a lot of value to its shareholders. The share buyback was a really important factor for the growth of its shares. So instead, that money will be invested in stores and employees. Management believes that this is the best decision long term. We will see how this plays out. Revenue has been consistently increasing every year. Even with the closure of stores in 2020, Starbucks and their management made the right decisions to preserve cash, and as soon as everything went back to the new normal, Starbucks started providing service like nothing happened. We can see the same thing with the earnings per share. Pure uptrend except for 2020. I believe the future earnings per share will continue to grow as the company continues to expand. The company has a 31% year-over-year revenue with a 6% 3-year compounded growth. This is big. When we compare it to similar sector companies like McDonald's, it's 31% year-over-year from Starbucks versus 20% from McDonald's. So Starbucks is a cash-generating machine. Long term, we will see if they can sustain this consistency as the company matures. Heading over to the dividend, it has a 2.46% yield with an annual payout of $1.96. The dividend has been increased for the last 11 years, and it has a 15.87% compound growth. Again, this is big. Payout ratio is 56%. This is fairly low, and it gives tons of room for future dividend increases. Some investors see the decision of cancel buybacks as a bad move. I can understand that it brings lower shareholder value to us, but the money is being reinvested into the company. If Starbucks continues to expand and continues to increase their revenue, the profit margins will expand. Long term, this could mean more cash for a bigger buyback, sustainable dividend increases, and long-term double-digit 5-year compounded rate. The third one will be the latest addition to my portfolio, JPMorgan Chase. JPMorgan is an American multinational investment bank and financial service holding company. The stock is trading at $126.12 and is currently down 22% year to date. They recently had earnings as well. They missed the earnings revenue per share by 7 cents but beat their revenue by 170 million. Overall, still down 5% year over year. The bank also had 524 million in losses for credit adjustments related to certain exposure to Russia-associated counterparties. And last but not least, the board of directors authorized a 30 billion stock buyback effective May 1st, 2022. So, is JP Morgan making money? Yes, they are. Even with the low interest environment, they bounced back from the drop in 2020. I also believe that they will be the future estimates for 2022 and so on. We can see the same reflection on the earnings per share, the same drop in 2020, but with a lower long-term outlook. I strongly believe JPM will beat these analyst estimates in the future. The revenue is 27% year over year with an 8% 3-year compounded growth. Looking at the dividends, it currently has a 3% yield with an annual payout of $4. The payout is 24.92% with a 15% 5-year compounded growth rate. JP Morgan has a lot of cash to continuously grow the dividend at this rate. Even if they slow down in the future, I'm pretty sure it will be above 10%. This is a pure dividend growth machine. So in conclusion, even if JP Morgan is trending to a 52-week low and having credit losses due to geopolitical situations, the company is doing fairly well, even in this low interest environment. The Feds will have several meetings this year about interest rate increases. Banks make more money when interest rates are hiked. Taking this into consideration with other aspects of JP Morgan, I see a bright future for the position that I'm starting now. Moving forward to my portfolio, where I invest $100 every week, portfolio value is $5,979.93 with a dividend yield of 3.01%. which translates to an annual dividend of $174.63 with 16 holdings. Several changes happened. The first one will be that the yield and the annual dividend went down due to the dividend reduction of AT&T. I also sold Kellogg's the previous week. Kellogg's was a high yielder, so that also affected the dividend yield of my portfolio. Then started the position at JP Morgan. That leaves me with 16 holdings instead of 15. Most of the dividend reduction was recovered by deploying the capital gain from Kellogg's into AT&T and Starbucks. My goal this year is to have a $10,000 portfolio value and $300 in yearly dividends. Looking at the companies I am investing in, I should be there by October, assuming that the market is in my favor. For this week, I bought Corning, AT&T, Waste Management, Starbucks, and JP Morgan. I will slowly focus on high growth dividends to ramp up my long-term income. So that will be it for today's video. Hope you enjoy it. Take care and see you on the next one.